In Chapter 1, I learned the function of an accounting system, and there are three parts of the functions. One is analysis. Analyze business events to determine if information should be captured by the accounting system. And bookkeeping, day-to-day keeping track of transactions. And then is evaluation. Use summary information to evaluate the financial health and performance of the business. And I learned these three organizations. One is IFRS. IFRS means International Financial Reporting Standards, and it's set by the IASB, and then it's GAAP, GAAP. The famous GAAP is the United States GAAP, US GAAP, and it is set by FASB. FASB is Financial Accounting Standard Board. It's too heavy. I can't handle this. Oh, this book is so heavy. How can I take this to school? Your school bag looks so heavy. Maybe I can help you. Quick. Wow, it's not a big deal. Let's go. How many do you want? 2 or 3? In Chapter 2, I learned what is balance sheet, and the accounting equation is assets equal to liabilities plus equity. And what is assets? It's cash account receivable. And what is liabilities? It's accounts payable and notes payable. And what is equity? It's retained earnings and capital stock. And the balance sheets can let us know how the companies work, and then we will put resources into assets part and the sources of funding into liabilities and equity part. And that is what I learned in Chapter 2. In Chapter 3, we learn T-account, which is a really good learning tool, and it is a simplified depiction of an account in the form of a letter T. And after finish the T-account, we will write journal entries to let our managers know every day's finance. And that is the example. We write if we return money to the company, and then we reduce cash and accounts payable. So we write 100 in the credit side of cash and write 100 in the debit side of accounts payable. And then we make journal entries. We will write the date first, and then we put account payable in the debit side and cash in credit side. In Chapter 4, we learn adjusting entries, and there are 4 categories of adjust entry. One is unrecorded receivable, and it is a kind of asset. So we will write asset in debit side and revenue in credit side. And then is unrecorded liability. We will write expense in debit side and liability in credit side. And then the third one is unearned revenue. We will write expense in debit side and asset in credit side. The last one is prepaid expense. We will write liability in debit side and revenue in credit side. And that is how I learned in Chapter 4. It's really important, adjusting entries.
In Chapter 5, we learned that the activity of most business, and it can be divided into 3 groups. The first one is operating activities. Operating activities are the transactions and events that involve selling products or services and incurring the necessary expenses associated with the primary activities of the business, like buying inventory and providing service. And the second one is investing activities. Those are the transactions and events that involve the purchase and the sale of property, plants, equipment, and other assets that are not generally held for sale. The third one is financing activities. Financing activities are the transactions and events that resources are obtained from or repaid to owners and creditors. So these 3 activities are those that we learned from Chapter 5. Hey, excuse me, where's the library?
不要跟我讲英文 I'm fine, I'm fine.
Hey, excuse me, where's the library?
Oh, I know that. Just go straight and turn left. You can see a library. It's a piece of cake.
Thank you so much. In Chapter 6, we learned that there are 2 accounting equations to manage receivables. The first one is the accounts receivable turnover. So the accounts receivable turnover ratio is an attempt to determine how many times during a year a company is turning over or collecting its receivables. So we divide net sales revenue by average accounts receivable. The second equation is the average collection period. So accounts receivable turnover can be converted into the number of days using this equation. So we divide 365 by accounts receivable turnover. And if a company gets a shorter period of average collection, it means that the company has a good manage of receivables. So this is what we learned in Chapter 6.
Hey, can you help me to do some mathematics?
Of course.
Quickly, quickly. What are you doing? Okay, fine. I'll find someone to help me. Hey, can you help me with some mathematics?
Of course.
Okay, 100 plus 200. Whoa, you're so smart. And 300 plus 400. Whoa, how can you do this so fast?
I practice a lot in the accounting class. In Chapter 7, we are discussing inventory. So pretend that the goods are in transit. So if the seller and buyer they decided to use the FOB shipping point, it means that the goods belongs to the buyer already. But if they decided to use the FOB destination, it means that the goods still belongs to the seller. So the second thing we learned is the brief cost formulas for inventory. There are FIFO, LIFO, and weighted average cost formula. The first one is FIFO. FIFO means first in, first out. So we assume that the oldest inventory units are sold and that the newest remain in the ending inventory. The second one is last in, first out. We assume that the newest inventory units are sold and that the oldest remain in the ending inventory. This way we don't use it in Taiwan and it is not in the GAAP. The third way is weighted average cost formula. We assign a common weighted average cost per unit to all units, both in cost of goods sold and in ending inventory. So these are the things we learned in chapter 7.